Friday, September 6th. The University of Colorado Golden Buffaloes tomorrow play the Nebraska Bug Eaters. Biggest game of the year. We lose 75-80% of them, but it's still the biggest game of the year. So, my lucky jersey. We rarely lose more than 3 out of 4 when I'm in it. Speaking of which, markets are arguably always in a case of indecision, but the indecision we're in right now is big. Rates reached bottom by Wednesday, and in a place where we'd been close to, but bottom, and then bounced up yesterday. And several things happened all at once that removed fear. And it's fear that pushes rates down. The things that happened in easily the most mistakenly reported financial event of recent times, Brexit seemed to recede. We've got an announcement of new negotiations with China, which pulls back on some of the trade fears, and some pretty good economic data. And rates were headed up. Rates themselves are chaotic. Fannie Mae money is close to 3.5. Jumbos are clear up above 4, which is, the jumbo market's a thin market. It can't absorb a lot of volume, and the pricing up above 4 is an indication of indigestion for a time. And then first thing this morning, we got news that only 100,000 jobs were created last month, and rates went back pretty much to where they had been. Jumbos are still dislocated, but the 10-year T-note still in the 150s. Media, I mean, I don't want to join the fake news bandwagon, as in invented news, but this business of every media person on earth desperately trying to exaggerate the lead, the headline, in order to attract eyeballs, makes it really hard on civilians to figure out what's important and what's not so important. So a brief rundown. The U.S. economy is just fine. Creating 100,000 jobs a month, unemployment unchanged at 3.7, wages growing year over year at 3.2. There's nothing wrong with that. The Fed has been trying for years to tamp down on job growth to a sustainable level. If job growth continues to slow down, if it slows down to nothing, if it goes negative, then it's a big deal, but that's not yet. In one of the early warning signs of trouble in the U.S. economy that's very reliable is credit distress in IOUs. There is no market pricing distress in corporate bonds, municipal bonds, consumer debt, or mortgages. Not even in junk bonds. Nothing. All of it's just exactly as it should be. So if tariffs are this terrible hazard to the economy, and it clearly is overseas, where is the linkage to the U.S. economy that's justification for the Fed to cut the cost of money? Even overseas, there's good reason to believe that China and Germany's multi-decadal predatory misbehavior is already causing their economies to stumble, and tariffs are pushing them into a heap from behind. As the copy nearby says, this is not as though Wile E. Coyote is walking along minding his own business and an Acme safe lands on him from a blue sky. The misbehavior of Germany and China is unsustainable to attempt only to run net exports and not import enough from the people who buy your junk. There is tremendous resistance inside the Fed to further rate cuts. In the copy nearby, there's a link to a speech by Eric Rosengren, who's the president of the Boston Fed and one of the best people in the whole of the Fed. He's the guy in the summer of 2008, before Lehman, who said quietly that credit distress has more than counteracted all of the Fed easing in the last year. And he was absolutely right, and it was followed 2 months later by Lehman. The Rosengren's position is we have no business cutting interest rates until we know that there is trouble in the U.S. economy. The counter-argument spins off into Monty Python of well, should we use our bullets now? Because if we don't, then it could get so bad that we don't have, and around it goes. But the bigger things immediately ahead. The European Central Bank meets next Thursday. And if they follow through with more of the stuff that they've been doing, much as it is criticized, nobody wants to live in a world without the stuff that they've been doing. Then the Fed meets the week after that. We are poised, and I would say tilted to lower rates. And we're going to be in expectation of more substantive weakness in the United States. That's what the market says. That's not what the numbers say. The numbers say the U.S. economy is just fine, thank you. Go Buffaloes. Have a good weekend.